An announcement on easing of foreign direct investment norms in the aviation and pharma sectors is likely later today, and we'll wait for those details to actually come through so that we know whether or not a liberalized or further liberalized regime in the aviation and in the pharma space is actually likely to take shape. As I mentioned, that announcement post 2 p.m. hasn't done much to set the street on fire. In fact, since we last checked, the Sensex and the Nifty have actually trended a shade lower. 82.10 on the Nifty 50, down up 0.5%, only 0.5% now. So 0.1% has been trimmed in terms of gains, and the Sensex up 0.5% as well at 26,762. Relative status quo. So let's address the other big policy change that is now firmly underway, and I'm talking about the Model GST Law, which was, of course, released by the government a few days ago. BMR Associates has done a comprehensive analysis on the implications of the Model GST Law on various sectors of the economy, and today I'm very pleased to welcome Mahesh Jaising, partner at BMR Associates, on the show to analyze in great detail what the Model GST Law really means for the IT sector, the software sector. Mr. Jaising, pleasure to have you back on NDTV Profit. Thanks very much for joining us. I'm going to start essentially with definitions, because when it comes to definitions, there's certainly been a relief for the software sector. I understand the meaning of service in the context of the Model GST Law clears ambiguity.
It certainly does. I think what the draft GST law does in terms of the definition of service is that it brings out certain deemed definitions, but more importantly, it says movable property shall not include tangibles. So what this will put to rest is that today software transactions, which are software licensing that corporates buy, there's an invariable debate. Is the transaction a sale of software attracting VAT, or is it a service attracting service tax? So as things stand, the industry has reconciled, and we have a dual tax of both a service tax and a VAT coming in on a software supplied electronically. What the draft GST law does is that in some sense, by harmonious reading of the definitions, it deems all transactions which are supplied electronically to be a service. So going forward, the software industry will welcome this GST law in some sense, because it does two things. It brings about certainty, it avoids a dual taxation as well, and more importantly, it will also bring about a reasonable ease in terms of figuring out where do you need to pay the GST, because if software supplied electronically were to be treated as sale of goods, then the debate gets a little bit more complicated without going into great detail of how do you tax and pay the tax on a software licensing transaction.
Does that cover pretty much all the principles that are there in this draft Model GST law on software taxation?
By and large, yes, but what remains ambiguous is that what happens to software that is supplied on a tangible media? Would that still get a character of an intangible and be deemed to be a service, or would it get a character of goods? That's still an ambiguous area, and industry is already, debating together. And obviously, this is the right time for all of us to be engaged with the government on feedback and inputs that we have on the GST law. And I would think the software industry would have that as their number one item, which is software on a media. Is it actually a character of goods, or is it a character of service?
Okay, we're going to constantly have a situation, Mr. Jaising, where I ask broad questions today, because this is a learning period for us and for our viewers as well, but we appreciate the details that you share with us. Now, when you look at it, when you look at this GST law from the point of view of export of IT services, what does it throw up?
So, India, the largest services exporters is the IT service sector. So, no doubt that this is a very important part of the IT services industry. What this does, the GST law, is three things. One, the export of service. When a company is providing a service to an overseas customer, that ought not to be taxed, because you cannot tax exports. That's a general principle. That remains, so that's good. But the current issue that companies have is that on the expenses that they incur other than the salary cost, they invariably incur a service tax cost and they apply for refunds. So one was hoping that under the GST law, the supply of services to service units based in a STP unit or an EOU unit will actually be zero rated, because companies, when they file for refunds, invariably it takes a fair amount of time, and it's a large pain point for service exporters. I'm afraid that under GST, based on this first draft, service exporters would continue to have a situation of having credit pools being built up and for them having to file a refund. In fact, it doesn't stop there. It moves a little ahead, because the current scheme of service tax allows exporters of services to claim refunds on a centralized basis. But going forward, they will potentially have to file refunds on a state level basis. So services exporters are a little worried, to say the least, in terms of how this will actually pan out, because this will indeed increase their working capital requirement and also increase a fair amount of their compliances.
It certainly sounds more cumbersome, Mr. Jaising. Would you say that there's potential for this to be addressed based on representations that are made by companies and experts like yourself?
I think there is, and I would like to even cover an important aspect of the service export regime. That is, a lot of the service exporters are housed in the special economic zones. So currently they have a special status, and they do get upfront exemption for the services that they procure. So on a practical basis, I'm quite hopeful that the SEZ units benefit should at least continue. But on the STP units, since today itself we are starting from a tax payment with a refund option, I'm not sure if the government will be completely willing to move to an upfront exemption on the sourcing side, because please remember, to get an upfront exemption, there is invariably some documentation and an even more detailed audit that the government and the tax authorities need to do. So in order to keep the law a little simple, I'm not sure for the STPs, but for SEZs, a fair amount of advocacy should go in, and I'm hopeful that for SEZs, the status should remain the same, for them being able to source the services duty-free and tax-free.
Okay, now I'm going to basically phrase the same question with a domestic focus. When it comes to the IT services sector within India, services offered within India by the industry, you know, the approach that's coming through in the GST law, what are the positive, negative implications?
So I think, unfortunately, that's the one that's going to have the most complexities. So let's take a step back. The current GST law in India is a dual GST. So we're going to have taxation of services at a state level. Now, with that generic statement, it's important to build on that companies have, IT companies, by and large, the large companies have pan-India operations. They have employees based in different states. So going forward, in some sense, they need to start paying taxes at a state level. So let's paint this picture. There is an IT company with headquartered in Bangalore and has 5 offices across the country. They have a contract with a telecom company, say, based in Gurgaon. The question then comes up is that, do they, raise a consolidated invoice from Bangalore to Gurgaon, or do they have to raise a decentralized invoice from each state? So the current draft model GST law does get into a fair level of detail on the place of supply rules, and it does emerge on a first reading that they need to probably discharge the tax at a state level from each and every fixed establishment from where the services are provided for. I think that's how the law reads. I think, therefore, what this means is that companies need to gear themselves up to be able to see how to slice and dice contracts with a fair value. But that's one part of the reading. Another part is going a little bit technical, but I think it's important that the service recipient can still possibly be the Gurgaon customer, and then he can transfer credits internally. But I would think the headline message is there is some scope for interpretation around the fine print, and it's paramount that the industry does engage with the tax authorities and the government on this front, because clearly any requirement to split contracts at a state level is indeed going to result in a fair amount of complexities, not only on administration side, but on the implementation side as well, because you need to then split contracts and billings.
Okay, I won't pretend to be a tax expert, but it does, of course, seem to suggest that the level of complexity in managing, administering taxes from the company's perspective is increasing. Correct me if I'm wrong, Mr. Jaising. Now, from the e-commerce perspective, what is the draft GST law delivering?
So the e-commerce, before we go into the nitty-gritty, because of the framework of GST, e-commerce industry today is faced with, states wanting them to come and take registrations in their respective states because there's loss of revenue, because today's tax regime is an origin-based tax, but under GST it will be a destination-based tax. So today we have even seen some states bringing in an entry tax to ensure that they get, some taxes for consumption in their states. So first things first, on that front, we'll hopefully see that all of this debate that e-commerce companies and the vendors on their platform have with the state should go away, because all states should in some sense get tax on their consumption in that state. So that's the first point. The whole GST law does reaffirm all of the understanding that this issue should broadly be addressed. But the draft GST law is, in some sense sprung up a surprise, and brought about an onerous task and responsibility on the e-commerce companies to actually deduct or collect a tax at source for payments that they need to make to a vendor. So to make it more simple, an e-commerce platform is actually a marketplace where they connect customers like you and me as individuals with vendors. But the government has effectively said that when you're collecting, say, 100 rupees for a transaction, and you're going to be transferring that money to the vendor, we would require you to deduct a particular percentage of tax and, give a tax deduction certificate to the particular vendor. Now, what this does is that it makes that vendor in slightly a disadvantageous position when he's making sales on an e-commerce platform, because his money gets blocked with tax credit certificates. But most importantly, it brings about a fair level of compliance on the e-commerce company to deduct taxes, to file tax returns. So I think this is an area that the e-commerce companies are extremely worried about, given the scale at which this industry is growing and the scale and size of operations. For them to be able to meet this tax compliance is indeed going to be onerous and difficult. So the draft GST law has brought this out, and I would think that this is not necessarily a welcome one for the e-commerce companies.
Okay, it's not a welcome one, and you've, addressed the whole issue of mounting compliance requirements by the e-commerce companies. What could be the alternative? And, I'm just trying to play out scenarios here and understand, is it likely that this could be addressed?
So, let's take the starting point. The states and the government are concerned that transactions that are taking place on an e-commerce platform, are they necessarily fully booked by the e-commerce vendors, not the companies, but the vendors on the platform? So I think the best workaround is to require the e-commerce companies to bring about a robust reporting of all the sales on their platform, which the law actually has brought about. So there are two parts. One is the tax collection at source. The other is the reporting part. And that should generally suffice, because the e-commerce transactions are very transparent. They're clearly on a platform with all the details of the sales of the vendors. So as long as those provisions are there, states should, their concern of transactions being appropriately accounted and tax appropriately discharged should be met, and they should be able to use the reports that the e-commerce companies submit to reconcile with vendors if they've actually paid the taxes or not. And I think that should be a workaround to deal with this current issue in hand.
Oh, Mr. Jaising, it's always a pleasure talking to you. The clarity you bring to extremely technical discussions, always appreciated. Thanks very much for joining us this afternoon.
Thank you.
All this week, we're going to be talking to BMR Associates on the Model GST Law and taking a close look at the sectoral impact every day this week on Power Lunch. Time for a quick break. We'll be back with lots more.